Audio test, audio test. Audio test. Am I coming through?
To be and people and the way that the market is acting as though they will be. The Treasury Secretary himself was speaking here in New York today at the New York Economic Club, and he used the word transitory. Now, the Fed was burned by thinking that inflation was transitory. The Treasury Secretary suggesting today that these are going to be one-time price increases, if anything, but they are going to be transitory.
You know, that's the conventional wisdom, Scott. First of all, the administration has two different arguments, and it's changed its argument. The first was that there would be no pain. Remember, the president said the exporters pay that. Well, they've now sort of internalized what the evidence is, and what almost every research paper I've read on it says is that the consumers pay the tariffs. Now they're into this idea of it's a one-time event. That is the conventional wisdom, but let me tell you, Scott, there's sufficient doubt about it because of the context. When you talk about the one-time price hike, you could think about 2018, where there were individual products that went up. But remember, inflation then was running below target. This is a different environment. Inflation's above target. The Fed is going to be worried about that, and it's going to take its time, I think, and be very patient in terms of adjusting rates because of that. Plus, you have companies have pricing power. They show that they can raise prices in the pandemic, and people are concerned about inflation to the point where inflation expectations are rising. I'm afraid here, Scott, the administration seems to me like it's lost the thread. Liz said earlier that she thought that the administration gave the market something, but then you hear what Megan reports, and I'm not sure they gave the market anywhere near what the market is looking for here. Looks like they backed off on about half of the tariffs, but then went forward and said, wait a second, all of those tariffs or something like it are going to go back on in April. You hear the reasons for the tariff. Lutnick came on this morning, said, oh, they're about fentanyl. But then he talks about the idea they're about autos being made in Canada. So the reason is unclear. You cannot connect the dots, Scott, about what happens next if you don't know what happened before. And a lot of people are scratching their head.
Well, I mean, it puts the Fed in a bit of a pickle. Speaking of, the chair himself, Jay Powell, is going to be speaking tomorrow, isn't he?
He is, and it's going to be very interesting to hear him talk about this issue of tariffs and how he looks about it. I will tell you, Scott, the market's pretty aggressive now about thinking that the Fed, I'm just going to look at what the current quotes I have are. We do have a full screen, I believe, on the outlook for rate cuts, and there's 3 built in. I must say I have my doubts about that because I'm trying to think of the month where the Fed is going to feel secure that there won't be price hikes coming to the CPI from tariffs. And then it's going to cut rates when you have an increase, even if it's one time in the CPI. I think that's not going to be the case. So I think the market, I'm looking here, Scott, at a 87% probability of a June cut and a 57% probability of a second cut in July. So the market's pretty aggressive, about 50 basis points. I have my doubts.
Steve, I appreciate you being here with us. Thank you. Thanks, of course, to our reporters, our market guests as well, and what is developing to be a very interesting and busy hour. For more now, let's welcome in the former Dallas Fed President, Robert Kaplan. He's now a Goldman Sachs Vice Chairman with me, as you see at Post 9. It's nice to have you on a day like this.
Good to see you.
How tough of a spot is the Fed in now?
They're going to have to balance what is a potential slowing in the economy versus the fact that inflation progress has stalled out and, if anything, may be going a little bit backwards. And so, unlike 2019, I was there when we cut rates in response to tariffs because we're worried about slower growth. Fed's more constrained now. And so they'll have to balance the fact that the inflation job isn't done. And I agree with Steve. I think when you see the SEP, the forecast in March, I think the market will be somewhat disappointed. I would guess the median will be closer to 2 cuts, not 3 or 4.
I mean, you've clearly articulated why they are in the pickle that they may be. Where do they err? Do they err on the side of the economy? Even if they're worried about the impacts that they don't know from inflation, they can't let one get out of hand at the expense of the other.
So one of the things I'd be thinking about, this administration's been in office maybe not even exactly 6 weeks. Between now and the March meeting, I would guess there'll be enough fog that the right answer will clearly be to do nothing. They'll then have a number of weeks to assess what's going on in the economy. There's 4 or 5 structural changes going on at once. That's why the tariff thing is only part of it. You've got government spending cuts that would slow growth, might be disinflationary. You've got a severe curtailment in immigration. And so slowing workforce growth, that slows growth. You have regulatory reform, but it's on the come. It hasn't happened yet. You've got a change in energy, and then tariffs. And the reason tariffs is such a problem, why I think the market is reacting the way it is, if you're going to have a tariff dispute with China or Europe, that's one thing. But if you're going to domicile manufacturing in the United States, integrated supply chain and logistic relationships with Mexico and Canada is central to being globally competitive. We operate as a North American continent, and I think that's why the market was so surprised by these actions.
I mean, can you bring all of the manufacturing? It sounds like you're addressing this now. Can you bring all of the manufacturing back to this country, like the administration clearly wants to do, with having a longer-term build in inflationary pressures, i.e. prices going up?
So the number one thing a CEO asks when they expand manufacturing is it globally competitive? And the issue is the way U.S. manufacturers have been able to be globally competitive and take share from Asia is using Mexico and Canada to do logistics and supply chains. 40% of the imports from Mexico is U.S. content that's been going back and forth across the border. And that's why if we want to get people to reshore, you need to have Mexico and Canada in order to induce people to reshore. So I think that's a challenge to the argument that this is intended for reshoring.
The idea of tariffs and one-time price increases, like the administration is suggesting, can be transitory. I want to listen to exactly what Secretary Bessent said today here in New York, and then I'd get your reaction, if I could, on the other side.
As we deleverage the government sector, re-leverage the private sector, which we'll talk about later. And look, can tariffs be a one-time price adjustment? Yes. While I've agreed not to talk about prospective Fed policy going forward, I would hope that the failed team transitory could get back together and think that nothing is more transitory than tariffs if it's a one-time price adjustment.
That's the Treasury Secretary earlier this afternoon. What do you say?
So even before these tariffs were put on, inflation progress is going sideways. Let's put it this way. The tariffs certainly don't help to create more inflation progress. They may hurt. He may be right, but the jury's out. And so it may turn out that the government spending cuts help with disinflation and other things, but the tariffs at a minimum, we know they don't help. They may not hurt as much as people fear, but they don't help. And we do know they probably slow growth.
I think I heard the Treasury Secretary say failed team transitory addressing the Fed. Right. That the Fed made the miscalculation that the inflation was transitory. On that note, the nominee for the Council of Economic Advisors suggested that the Fed didn't tighten aggressively enough to fully put out inflation, and that they should have put the economy in a contraction, and that would have done it, which has led inflation to persist like it has now. Your reaction?
Yeah. So the transitory and other things the Fed might have done in 21 or 22, as you know, I thought they were late. They're worried too much about prognosticating, not enough about being a risk manager. I think they've learned that lesson. And so what they're going to want to do is let these events unfold. They're obviously changing day by day. They want to let them unfold, see how they materialize, see how this puzzle unfolds, and be patient. And I think one of the lessons of the transitory experience, don't try to be a prognosticator if you're at the Fed. Be a risk manager.
I mentioned your current role at Goldman Sachs as vice chairman. I'm guessing, you can correct me, obviously, that at some point through all this, the executive leadership at the highest levels of the firm is reaching out to somebody like you to say, hey, what is this all going to mean for the economy? How should we think about this?
Okay.
Do you think recession risks have gone up? How would you answer that, if I'm anywhere near correct?
So I spend 2/3 of my time talking to clients, and I learn a lot from clients. So what I'm hearing from clients is, we started the year very enthusiastic. We have a number of actions we want to take, and what they're now saying is, let's not no, but not now. They're slowing down. There's enormous uncertainty, either from government spending cuts, labor force availability. Tariffs is now a new uncertainty. And what I'm hearing is consumers are taking pause, CEOs are taking pause. It's not that they won't get back to wanting to take action. So the economy, we felt for some time, I felt is slowing. The question is it slowing down to 1 3/4, 2% run rate, or is it something less than that? I think one of the things the administration could do that would help is give clarity to how far they want to go with the deportations, so that workers who are in the workforce but not sure whether they're a target of this will know whether they can shop and go out more aggressively, and also some clarity and resolution on Mexico and Canada. I think both those things would help CEOs to be more aggressive and forward-leaning.
I got to go. I'm already going to get in trouble, but the Atlanta Fed GDP now, it's like -2.4 now. How much credence should we put in that in the way we think about the economy?
Well, it was based on particularly on the trade items and other items. That I would guess the economy is slowing. It's not negative, but it is slowing. I think we'll probably have better input than that number in the weeks ahead.
I appreciate your time so very much, being here to help us understand all this. Robert, thank you.
Good to talk to you,
Robert
Scott.
Kaplan. We're just getting started here. Still to come, Apollo Global Management's Brian Furtado tells us how he is navigating this uncertainty. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC.
Looks like we have put in the bottom. I'm done trading for the day. But looks like we're going to put in a double bottom here. And we got half hour to go to the close. I was surprised by this move down. I expected a pullback and then go to the 200. So we tested the 20,000 mark. And we haven't seen anything lower than that. Once we take out this red bar, I think it's all done for the lows on a 5-minute chart here. Anybody traded today? Made any money? Or just watch the markets? Small losses are okay, as long as they don't get out of control. But I mean, it's hard to keep the stops small when these bars are just 20, 30, 40 points, 50 points. You need a stop of at least 30 points to 50. So
Insurance.
You're going to see robotic production of iPhones and the jobs that are going to be created, people who build those factories, the mechanics who work on those robots. These jobs are going to be millions and millions of those jobs. These are great, high-paying jobs, and you don't need a college education to do it. This is the recreation of tradecraft in the United States of America, and Donald Trump is on it. He's bringing it back, and you are going to see Apple. Why did Apple say they were going to invest $500 billion in America? Because they're going to build the robots to build their iPhones in America.
Well, that was Commerce Secretary Howard Lutnick earlier today on CNBC. Let's bring in our Steve Kovac. He covers Apple for us. What do you make of what the Commerce Secretary said, Steve?
Yeah, Scott, just about everything he said is not actually what's happening with Apple, and especially related to that $500 billion announcement they made last week. So let's just stick to the manufacturing thing, because that's what he focused on. It's not iPhones. It's those artificial intelligence servers for Apple Intelligence that instead of making overseas, they're going to start making at a new facility over in Houston, Texas. And then on the robotic front, that is just not in the cards at all. That technology is a long ways off. I know we get excited about the Tesla Optimus robot and things like that. But if you look what's going on overseas where these iPhones are made, those are humans making it. Thousands of humans travel in from rural China into Shenzhen to make those products. And then as far as bringing the iPhone manufacturing to the United States, that's just a logistical and expensive nightmare to do that. It's not going to have the workforce here that they have in China, that they have in places like India. And oh, by the way, India is a great place to talk about when we're talking about shifting iPhone production. Apple actually started doing that back in 2017. Here we are in 2025, and it's still just a very small fraction of the iPhones in total that are being made, 14% according to a Bloomberg estimate. That's nowhere close enough after 8 years of trying it on the ground. Now extrapolate that, bring it to the United States. It's not going to happen anytime soon, Scott.
Appreciate the update and the clarity on all of that. Steve, thank you.
You got
Steve
it.
Kovac. Up next, Apollo Global Management's Brian Furtado is mapping out where he is forecasting stability in this volatile market. He'll join me right here at Post 9 after the break. Back after this. think you know by now, yet another volatile day for stocks, with the S&P heading for its 6th straight day of a move 1% or bigger. One reason our next guest says private markets could offer investors respite from these stomach-churning swings. Let's bring in Brian Furtado. He's partner and head of family office business at Apollo Global Management. Good to see you.
Scott, it's great to see you again.
Yeah,
thanks for having me.
These are kind of crazy times, obviously, in the market. From your perspective, how do you feel about it?
Yeah, no, incredible times. I mean, really volatile right now, obviously. And, you know, we see this as really just an adjustment phase. You know, obviously, we're looking closely right now at consumer sentiment, at corporate sentiment, and just watching closely to see how, you know, those reactions happen. We've been looking at some of the data there, and, you know, it's clear that that's getting a little softer on both fronts. And so that's going to mean that we have to look closely at unemployment levels, you know, going forward, and potentially, you know, what happens there with the Fed. So these are big changes that could be coming. Obviously, the jobless claims today was a little better than expected, so that's a good sign. But more volatility, but means that, you know, as investors, we'll have to be thinking more about diversification for sure.
And how so are you doing that? I mean, the equity market is obviously volatile. Credit's been pretty good.
Right.
Spreads are, you know, widening a little bit, but nothing to raise the alarm bells.
Yeah, no, on the credit side, you know, spreads are pretty tight. So there, we can talk about that in a minute a little bit in terms of what we're doing there to kind of improve on that. On the investment grade side, spreads are very tight. But if you look at, you know, and I think we could talk about this in terms of equities and credit, in terms of just thinking about how do you replace those exposures, but do it in a less volatile way. And I think that's the most important thing in these markets right now, because the markets are moving so quickly. And so the promise of alternatives, obviously, and Apollo is obviously very focused on that for our clients.
Sure.
And blending those into portfolios. So we're seeing the super large family office clients, you know, really think about like how do they, you know, get more liquidity in their portfolios, because obviously family offices have been somewhat overloaded, you know, in private equity here, just like endowments and big institutions. And so they're looking to improve their liquidity, not necessarily go into liquid markets, but sort of that middle ground of semi-liquid alternatives. And then likewise, at the other end of the spectrum, the high net worth investor is looking to get more alternatives into their portfolio, get more diversification in their portfolio, and get more semi-liquid structures. So they're sort of meeting in the middle, if you like, in their portfolios right now.
This was thought to be, and I think there was a lot of optimism coming into the year that private equity was going to have a great year.
Right.
Realizations were going to be up for, you know, the first time in a while. You guys have been sitting on a lot of stuff you want to get done, and it feels like that's pushed off.
Right. Yes.
You know, I love what Robert Kaplan told me a short time ago, the former Dallas Fed president, when talking to, you know, his clients about doing things. It's not no. It's not now.
Yeah, just not, and certainly not now, because, and this is the uncertainty that this is really creating is meaning that, you know, things are getting pushed off, IPOs getting pushed off, et cetera. And so we're seeing somewhat of a slowdown there, but we're seeing companies actually, and sort of a lot of private companies looking in the middle at like what we're calling hybrid structures. So they're looking for equity capital, but they're also looking for creative solutions. We call it structured equity. And so they're looking for lending and collateralized investments, but alongside an equity investment to unlock some ability for them to do things in their businesses. So that's an interesting area in the markets. And it's another way of getting diversification, back to your original question, in portfolios. We've got to be thinking a little bit differently, I think, in these markets, because just the regular way 60-40 portfolio is probably not a great place to be here. And so blending alternatives in, whether it's in credit, whether it's in private equity, to improve that diversification is really going to help a lot in these markets. And I can just tell you from my conversations literally just today, coming down in the car on my way here.
Always doing work. Okay.
Yeah, we've got a lot of people that are like starting to accelerate those conversations and move a little bit more quickly than they would have maybe 3 or 4 months ago, when they were saying, oh, you know, I'm loving these equity market returns and we're going to stick with this for a while. But you really are seeing it real time now as people are starting to make moves in the portfolios.
Oh, because the volatility in the equity market has forced them into other areas of alternatives. Like when we talk about that, and on this program, we focus so heavily, you know, on the network too, on private credit.
Right.
I love what Howard Marks, he puts out these letters all the time. And he put one out. He says, when people ask me, can we talk about private credit? My answer is always the same. Can we talk about credit?
Right.
Like, there are a lot of opportunities. Mark Okada from Sycamore Tree was with us a couple days ago.
Yeah.
Talk about the tremendous opportunities that right now exist in credit.
Oh yeah, credit opportunities are amazing, and people talk, and it's really like sort of lumped into one big bucket, as Howard, as you mentioned, and really, we think of it as corporate credit, obviously, and then there's asset-backed lending, which is a really big part of credit that has heretofore been really on bank balance sheets, but now a lot of that's coming out. And so Apollo, we actually have 16 platforms that originate credit. No one really knows about these platforms, but they're the biggest trucking and leasing platforms, they're the biggest aircraft leasing platforms, etc. They're originating credit that we're now putting through conduits into our clients. So they have hard assets backing them, and they can get some really interesting yields. And so this is what's happening with the wealth business, is that sort of more institutional products that were sort of not really available to the high net worth client, to the wealth clients, to the family office clients, are now being repackaged through the wealth ecosystem. And now we have the ability to offer them to clients, and they're providing great diversification, especially in these markets. So, of all days to be here, it's a super interesting day to be here with you, of course.
Yeah, of course, to talk about everything other than the equity market.
Right. And we're thrilled to do that because it's not the market that we're in.
Yep. We'll have another conversation about it, too. Thanks for coming down here.
Really appreciate
your time
Thanks,
today.
Scott.
That's
Really
Brian Furtado, again at Apollo Global Management. Up next, we're tracking the biggest movers as we head into the close. Christina Partsenevelos is standing by for us with that. Hi, Christina.
Hi, Scott. Well, two companies are actually defying the odds right now. One big box retailer keeps customers loyal despite economic headwinds, while a cloud security leader rides a wave of demand to a stronger future. We break it down next.
We're less than 15 from the bell. Back to Christina for the stock she's watching. Tell us.
I have some positive names. Zscaler shares are higher after it posted better than expected second quarter results. The company also raising its 2025 revenue forecast and increasing demand for its cloud-based security services. And that's why you can see shares up 3.5%. Its best day in over a month, despite the sell-off. And positive results also sending shares of BJ's into the green. The big box retailer said it's well positioned to keep members coming back despite low consumer confidence as well as tariffs. It also bucked the retail trend by providing an inline outlook, and that's why you're seeing shares up 11%, its best day since November 2021. Glimmers of hope, Scott.
All right, we'll take it. Christina, thank you. Christina Parson-Evelis. To Julia Borston now for a look at how shares of Netflix are faring today. Julia?
Scott, Netflix shares are getting crushed, now down 9%. Yesterday afternoon, CFO Spence Newman said at the Morgan Stanley TMT conference that the company's $18 billion in content spend this year, up 11% from last year, is, quote, not anywhere near a ceiling. And a new MoffettNathanson report out today reiterating a neutral rating and an $850 price target for the stock, saying that they expect the benefits of password sharing crackdown to slow in coming quarters. And there's another factor that could be weighing on the stock. Its nascent ad business, along with the rest of the ad market, is facing growing uncertainty. Scott?
All right, Julia, thanks so much, Julia Borston. We are getting some more headlines related to the Fed, this time from Fed Governor Christopher Waller. Steve Leisman is here with that. What is Mr. Waller saying, Steve?
Governor Waller is saying that rate cuts are possible after March. That is, doesn't see them happening in March, but he also says that 2 rate cuts, Scott, remain reasonable as a forecast for this year. He's waiting to see if the weakness, and we've talked about this, in the softer data shows up in the broader or the harder data. He does say Fed policy is still restrictive, but on the issue of tariffs and the ability, whether or not they will be passed on to consumers, he says it's very hard to eat a 25% tariff, and he believes that companies will move, Scott, in order to protect their profits and profit margins.
All right. Thanks for that update, Steve. Thank you once again. That's Steve Leisman, Senior Economics Correspondent. Still ahead, we drill down on some big moves in the energy space today. And as we head out, a quick check on the market here. We're still down about 4. Well, there you go. You see the losses there on your screen here. The Dow down 1%, S&P down near 2. It's the NASDAQ, of course, where the weakness is really persisting, down 2.75%. We're back after this.
Guaranteed.
All right, coming up next, we break down some big moves in energy today. The market zone's coming up next. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Pippa Stevens taking a look at energy and shares of nat gas producer Venture Global Force as well. Mike, your thoughts on how this market continues to trade?
Spending a lot of time in the same area. The lows every day so far for the last three have been right in that same spot. It seems a little bit neat and tidy that would be the firm and final bottom, and the NASDAQ 100 down 10%, also sitting on the 20,000 level. So a lot of this stuff is kind of coming together. You have to acknowledge markets plausibly oversold enough to bounce here. It's dealing with a lot of stuff, but I do think you could still work with a framework that says we've probably seen the max tariff pressure. Not that it's going to get better, not that it's going to get too clear very soon, but it's probably not going to get incrementally worse. And the jobs number tomorrow is going to inform us a lot about what economy we're dealing with right now. The growth scare story is way out on the surface now. It was kind of a nuanced thing a few weeks ago. All that being said, job number Fridays are sometimes an inflection. You got to be aware that you're primed to have some relief, even if it doesn't seem like it would be the climactic.
I mean, if nothing else, we know that we're going to be dealing with tariff headlines for another month at minimum. There is energy today, Pippa Stevens. There is a lot of red on the board. That sector, however, is green.
Yeah, that's right, Scott. So energy stocks did reverse earlier losses, and they're now the sole sector in the green as oil drifts higher. Still the worst sector on the week, though, amid a cloudy demand outlook and oversupply concerns. But take a look at shares of Venture Global. This is the company that went public in January with high hopes it could revive the energy IPO market and is one of the only pure play LNG stocks. But Q4 exports declined 18%. The company said its Plaquemines plant in Louisiana could cost $1.3 billion more than prior estimates, and they issued disappointing guidance. It also remains mired in disputes with customers, including Shell, who say Venture Global failed to deliver contracted cargoes. For the full year 2025, the company now sees adjusted EBITDA of $6.8 to $7.4 billion, far short of the $9.3 billion that analysts were looking for. That stock is now down more than 30%. Scott?
All right, Pippa, thank you. That's Pippa Stevens. Momentum relief.
Yes.
None to be found.
No, exactly. It really is important to understand how much that still is spilling into the market. Momentum factor ETF down 4% today. The banks being down. Obviously, there's a lot of agitated global capital market stuff going on with European yields flying and the dollar really getting crunched. And that doesn't help financials usually. But that also was a crowded trade. And I think you have some unwind there. In fact, if you look at the downside leaders today, it's not about tariff exposed companies for the most part. It is big cap over-owned tech. So look, at the lows today in the S&P, you're less than 1% above the July peak, right? You had that big July peak. That was the Mag 7 dominance moment. And so you've done some work here on the downside, going back in time testing. I don't think it means we're washed out or anything like that, but it does mean that we've reset expectations to at least some degree. And I'm really watching FX volatility and bond market volatility, because that could create the circumstances that we had in early August with that yen carry trade panic.
Yeah, I mean, we talk about momentum. NASDAQ obviously is the focal point there, and it goes out 2 2/3% red. We're red across the board, though. We'll pick it up tomorrow. For now, I'll send it into overtime with Morgan and John.
Well, that's the end of regulation. And Dimensional Fund Advisors ringing the closing bell at the New York Stock Exchange. Girls Who Invest doing the honors at the NASDAQ. Another nosedive for stocks today, with the NASDAQ seeing the most pain, dragged down by mega caps like Nvidia and Amazon as tariff fears grip investors. Layoffs, data jumps, a lot of uncertainty in this market. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Ford.
And chip stocks taking on the chin today after Marvell's results, and we'll get more clarity on the space in a few minutes. When Broadcom results, that stock is down about 6% ahead of earnings. We're going to bring you those numbers as soon as they cross, and we'll also get earnings from Costco, Gap, HPE, and Samsara.
Plus, Somroll creator Claudia Sam reacts to today's Challenger layoffs number. It's the highest since 2020, ahead of tomorrow's jobs report.
And Rockefeller's Ruchir Sharma on why he says President Trump's policies are, quote, making the rest of the world great again, at least from an investment perspective.
Well, let's get straight to the market action and another ugly day on Wall Street. Joining us right now is BD8 Capital Partners CEO Barbara Durant and CFRA Research Chief Investment Strategist Sam Stovall. It's good to have you both here. And Sam, I'm going to start with you. We've got an S&P. It's still settling out here, but it looks like down about 1.7%. 57.38 perhaps is where we land here. Every sector in the red except energy. And as we just mentioned, big cap tech and the NASDAQ really taking the worst of it today. Where does this leave us with the market? And where should investors be focusing when there are so many bricks in the wall of worry?
Well, I think it confirms that there is still a defensive shift that is going on. And just before the close, consumer staples was in the green. So that sort of gives me the feeling that investors continue to rotate rather than totally retreat. So we're continuing to see some of the defensive areas, consumer staples, healthcare, that are doing well on a year-to-date basis, whereas the worst performers, the only negative ones, are technology and consumer discretionary on a year-to-date basis. So it says to me that, yes, investors are unnerved by the tariff situation. The longer the tariffs remain in place, the deeper this market is likely to go. But I still think investors are expecting to see a rotation rather than a true rout and retreat.
Barbara, do you see it the same way? And if so, what would you be buying right now amid the sell-off?
Well, not quite. I mean, what I think we're seeing is a real old-fashioned growth scare. And I think a lot of it stems from policy uncertainty, whether it's about DOGE. We're not hearing much about the deportations, but that's also, a concern, but also the tariffs. And I think you've seen that show up in a number of ways. For instance, in February, we actually had an increase in consumer income about double what was expected. And yet consumer spending was half what was expected. And I think that reflects on 2 weeks ago, we had two different consumer confidence surveys, big jump in inflation expectations. So I think it's causing a hesitation in consumers. And then we had the manufacturing data, which showed prices going up, but employment going down. And I think that, and also new orders. So I think that's companies showing they are hesitating. I think that when there's so much uncertainty, both corporations, companies, and consumers pull back. And it doesn't mean because they don't have the money. And the problem is this could get deeper, if this uncertainty goes on. And as we know, it looks like at least another month and probably more before we get clarity in the tariffs. So I think you're seeing classic throw out the momentum trade. The momentum trade is over. The Mag 7 as a group is down 15%. What their earnings haven't changed, maybe Tesla. There's some fundamental issues there, I think. But I think that this is an opportunity to get the shopping list ready. I don't know where the market bottoms, probably somewhere in here. But I think you just get your list ready and you start to buy if you have some cash, knowing that things could go a little bit lower.
Sam, if this is about a growth scare and not just about tariffs themselves, we're about to get a lot of valuable data points in tomorrow's jobs report. What are the chances that one or more of those numbers shifts the narratives here? What should investors be looking for?
Well, I think certainly you look for the overall number. Our expectation is for 155,000 jobs versus the street's 160. We do think that unemployment will tick up to 4.1% from 4.0. But I think you also have just to look at each of the other leaves within this artichoke to get to the heart of the matter. And our belief is that while there is a possibility of a slowdown in growth in the economy, I mean, we had been anticipating a 2.5% real GDP growth in 2025. Now that's down to 2.2%. We're still looking for an economy that's growing above 2% through 2026. So the narrative has not shifted, in our opinion, to recession yet, but certainly it is a shift in momentum going from the tech stocks into the more defensive areas.
Okay, hold on. Hewlett-Packard Enterprise earnings are out. Christina Partsinevelos has the numbers. Christina.
It is a mixed quarter with more job cuts coming for HPE, which operates in server, storage, networking, and software. The company set to cut a further 2,500 positions, and that'll be over the next 12 to 18 months. As for earnings, the company posting in-line earnings per share with revenues of $7.85 billion, which was a slight beat. The Q1 server revenue coming in a touch higher too at $4.29 billion, but margins are slipping. Big part of the why the stock is dropping now. Margins are coming in at about 29.4% for Q1, down from last year, down from last quarter. I spoke with HPE CEO Antonio Neri, and he told me the drop came from three factors. One, pricing pressure in both AI and traditional server markets. Number two, the inventory reevaluation that they had, specifically adjustments to their inventory. And number three, higher than normal AI inventory due to the rapid transition from Hopper to Blackwell GPU chips, something we heard from other players like Supermicro and Dell. And these are found in HPE servers as well. So looking ahead, though, the outlook is also weak. Both Q2 revenue and earnings per share are below estimates. Neri pointing to tariffs, especially in Mexico, as a major headwind, stock down almost 12%.
All right, Christina, thank you. Barb, I'm particularly curious about how Samsara is going to fare with its results, given what Marvell and MongoDB did. MongoDB, really bad trade post-earnings here. And Samsara had been doing a lot of beating and raising. That ticker IoT, really doing a lot of sensors on trucks, cost-saving use of data, and eventually AI. What are these dramatic moves that we saw yesterday telling us about how the market's priced and what investors are willing to do with growth and smaller technology stocks?
Well, what I think you're seeing in general is a squeezing out of the AI premium in a lot of these names, and people trying to really gauge, when do things kick in, like HPE that just reported. I mean, the AI service, I think a lot of investors understood, there's transition issues, the GPU, there are competition issues, they're waiting for the Juniper merger to happen, and that will probably bring it in the second half, be a much better story for them. But in the case of Samsara, they really are best in class in a very fragmented vertical industry. And eventually, the competition is coming for them. You've got bigger players, who can do things more cheaply. And you've also got some OEMs that will probably build in some of the tech capabilities that they're now offering through third-party software. But their numbers should be good. And it should be a good outlook, because it's really been an industry that has been so fragmented and clients need this. And so they've grown really quickly and probably the highest growth software company right now. So I would be surprised if they're already seeing a growth slowdown, but we'll soon know.
Soon. Barbara Duran, Sam Stovall, thanks to you both. Let's get now to Mike Santoli for more on the sell-off. Mike?
Yeah, John, S&P 500 really unable to get much kind of oomph on these rally attempts, but also kind of bottoming in a similar area around the 5,700 mark. The past few days, it has crossed below, scissoring back and forth around this 200-day moving average. I always say there's nothing sort of magic about crossing it. It doesn't totally change the character of the market, but there is a lot of convergence of people who, one, think it's a buying opportunity, or on the other side, feel like that's when you kind of take a jump out of the market if it really breaches it. I would point out, too, that at the lows today, around 2,700, that's a little bit of a slant, but we were just less than 1% above this July peak. That was the real crescendo higher in Mag 7. And this was that pullback we got about 8-9%, and that was associated with the yen carry trade scare. So global capital market stress, or at least fast-moving indicators like the dollar getting kind of slammed today, also German yields flying, is something to keep an eye on, because we were also oversold, as we are right now after 2 weeks of selling, and you had a rally attempt, and then it took that flush lower for the yen carry trade to get us moving again. Anyway, here is a little bit of a capsule of the market-based sentiment. So fear and greed index, this is something maintained by CNN. It's really matching that sort of late July, early August low, which coincided with that buying opportunity, the market low. It does get lower. This is just low on a one-year scale. So at the bottom of real crashes and bear markets, it's in the single digits. It's right now like 17. But it's just something to keep in mind that things sometimes get wound pretty tight. It looks like there's no relief, and it can spring higher without a lot of warning, or at least you tend to be in the zone of time and price when maybe the market's going to try to find its footing, guys.
Mike, S&P's right back to where we were before Election Day, but at the same time, the VIX is a lot higher. What does that tell us?
Well, it tells you the path, and essentially the fact that we went down 7% in almost 2 weeks, as opposed to ascending to this same level a while back. So it's all about the cadence and whether we've been kind of had sellers or buyers in control. One thing to keep in mind, a VIX in the mid-20s, right now 24, 25. What that says quantitatively is that the market is bracing for about a 1.5% daily move in the S&P 500. That's kind of how it translates into an implied move. So it doesn't mean that it's going to move that much. It doesn't mean that this can't go higher. And it's really, really intense sell-offs are well above 30. So at this point, it just means we're on edge, we're on alert, and it's also reflecting just how volatile the market has been in the last couple of weeks.
We're seeing volatility in the FX markets, too, which I know we're going to talk about a little bit later this hour. Mike Santoli, we'll see you a little bit later. Thanks for being with us. We're just moments away from Broadcom's earnings results after a brutal day for chip stocks, including Broadcom. We'll bring those to you as soon as they cross.
And after the break, Rockefeller International's Ruchir Sharma weighs in on another big sell-off on Wall Street and why he says President Trump is making the rest of the world great again from an investment perspective. Overtime's back in 2.
Insurance.
Welcome back. We have a news alert on Intuitive Machines. This is the space exploration company that sank 20% in the regular session after attempting to soft land its commercial lunar lander on the moon. There's a press conference going on right now via NASA because the company was contracting with NASA through the CLIPS program on this mission. And here are some of the headlines we're getting right now. Intuitive Machines CEO Steve Altemus saying, quote, "We don't believe that this Athena lander is in the correct position on the moon, and that they don't believe it's in the correct attitude on the surface of the moon yet again," and saying that the mission will be, quote, "off nominal," which means the data that they do get back from this mission will be uncertain because of power generation issues from this incorrect landing position. Now, the lander is returning data despite this faulty landing. That's according to a NASA official. And the attempt had challenges to land, had challenges with the lander's laser range finders. Now, if you take a look right now, the stock's down 30% here in after hours. But if we were to show you a chart of the activity that we saw in Intuitive Machines during the regular trading session, this attempted landing happened right around 12:30 Eastern. The stock was briefly halted as that was playing out once it became realized through the commentary from Mission Control in the live stream that there were some complications and this landing was not playing out as had been expected. So this is the detail and the information we have now. This Athena lander did land on the moon. It did not land the way it was intended to, and it sounds like the mission has been compromised. How much remains to be seen, but the stock is down about 29% right now.
And meantime, earnings continue to roll in. Costco and Broadcom results have crossed the tape. We're going through them now, but Samsara results already. Seema Modi has them. Seema?
Samsara delivering a 4-cent beat on its bottom line, John. Revenue coming in ahead of consensus at $346 million. The estimate was for $335. I would point out that deferred revenue is a bit lighter than expected. And this is, of course, the company that specializes in fleet operations, real-time GPS, AI-powered dash cams. Let's talk about guidance. Its first quarter earnings per share guidance of 5 to 6 cents versus the estimate of 5. So generally in line with estimates, but as we've seen over the past couple of weeks, John, companies that haven't been able to raise, in some cases, have been punished, and we're looking at the stock down about 10%. And excluding today's price action, I would point out shares are down about 33% from its most recent high. I'll send it back to you.
All right, Seema, thank you. And Samsara's CEO is going to break down these results with us tomorrow right here on Overtime in an exclusive interview. Meantime, Broadcom results already. Christina Partsinevelos, how do they look?
Beat on the top and bottom line so far for this quarter. We're seeing EPS adjusted of $1.60 on revenues of $14.92 billion. As you can see, shares jumping about 7%. If we just look at Q2 revenue guide, that too is coming higher at $14.9 billion. I will continue to go through the report and come right back to you guys.
All right, Christina Partsinevelos, thank you. Well, back to today's wild market action. All three major averages now on track for their worst weeks, of the year after piling on heavy losses today. But it's a different story overseas where European and Asian markets are on a hot streak. They have been. Joining us now is Ruchir Sharma, Rockefeller International Chairman. Ruchir, it's good to have you on a day like today where we did see, in general this week, we've seen the dollar weaken significantly against other major currencies. We've seen stocks here sell off. But as we just mentioned, we've seen rallies in other parts of the world. What's driving that? And how much of that is based on the policies of President Trump here that are actually pushing policy pivots in other parts of the world?
Right. To put this in context, as I had sort of spoken with you and written back in December, that we had this concept in American exceptionalism reach bubble-like proportions, which is that the performance of the American stock market had really gone parabolic. In fact, in my 30 years of looking at markets, I had never seen an instance when a country was this overowned, overhyped, and overvalued relative to the rest of the world. So that's what was the context of coming into this year. Now what we're seeing is that bubble is being pricked, which is that after having outperformed global markets for 15 years, the American stock market is beginning to give up some of that outperformance. The dollar too began this year as being the most overvalued on some measures since its floating rate history, which goes back to the early 1970s. So that's the context. Now, what's causing this bubble to prick? I think it's a combination of the fact that the American economy had been artificially juiced up by a lot of government spending, and also the fact that the rest of the world is beginning to get its act together, partly because of Trump. They are facing a sort of existential crisis because of the policies out of the US. And so they're finally carrying out the kind of reforms that they should have done anyway, from Germany to China. And that's what's lifting their market. So this is the big reversal that's going on here.
It's interesting because when you frame it like that, and I'll use Germany as an example with the fact that it's now positioning itself to spend more on defense, it sounds like you're going to start to see, or you're already starting to see, more fiscal spending from other countries while the U.S. is actually pulling back on that very thing.
Exactly. But it's also carrying out the kind of reforms. I mean, Germany would have not carried out these kind of reforms, which goes beyond defense. It's got to do with infrastructure, and hopefully it extends to the supply side as well of deregulation. They would have not done that had it not been for the urgency because of what the Trump administration has been doing with Europe. Similarly, in China, there's been a sea change in Xi Jinping's attitude towards the private sector. And that's also happening because he realizes that he needs the private sector to be firing, because the export economy is going to be under threat under a Trump era. In countries like India, too, they have the highest tariffs, as Trump has pointed out. So now India is rushing to lower its tariff rates and do a deal with the U.S. that it should have done anyway to make itself more competitive. Okay. So I think that there are all these policy changes that are happening around the world.
So, Ruchir, what then are the implications for U.S. markets, even as they include a lot of companies that operate globally? I mean, if Germany indeed does crank up spending, at the same time Europe is relying less on America, perhaps, and even American products, if this China decoupling continues, partly driven perhaps by the U.S. Limiting the technology that's available to China to buy, if those reforms do indeed happen in other parts of the world, does the U.S. benefit as much or less than it would have previously?
Yeah, because so much capital got sucked into the U.S. If you just look at this decade, about $1.2 trillion flew into U.S. dedicated mutual funds, whereas hardly any money has gone into any global funds. So I think that there's ample scope for reallocation. So I think that the U.S. markets don't do well in this environment, and it's the international markets that outperform meaningfully. Remember, this is a 15-year record level of outperformance that we're coming into this. So I suspect that for the next few years, these other markets are going to do much better. And this gross overvaluation of the U.S. market, where the U.S. equity market came to be nearly 70% of the global stock market indices, compared to its economic weight of nearly 30%, I think that gap begins to close. So this is a seismic shift. It's just begun. And I suspect for the next few years, this is the story that we're going to be talking about, and it'll only become apparent with time.
All right. Everybody watch your 401ks. Ruchir Sharma, thank you.
Thank you.
Also, cue the QR code, because that leads in nicely to the latest installment of my On the Other Hand newsletter. This week's debate: will President Trump's rift with Europe hurt the U.S. markets? You can scan that code on your screen now to join the conversation. Well, now let's get back to Christina Partsinevelos. She's got more on Broadcom's results. That stock even higher than it was before, Christina.
Yeah, much of this has to do with just AI driving a lot of the demand in the first half of this year, when a lot of analysts and sell side were expecting that to happen in the second half. And I say that because you had semiconductor revenue come in at $8.2 billion, which was higher than the street anticipated. Infrastructure revenue also higher. But more specifically, their AI revenue actually climbed 77% year over year in Q1. So it came out to about $4.1 billion. But what they're anticipating for Q2 is that number to climb even higher to $4.4 billion, with the CEO saying in a statement, quote, that as hyperscalers partners continue to invest in AI XPUs, so there's the individual chips, and connectivity solutions for AI data centers. So in other words, he's telling us he's still bullish going into the following quarter because of these hyperscalers spending money. And so all of that strength, as well as the revenue guide coming in higher than anticipated, helping shares.
All right. Christina Partsinevelos, thank you.
Thanks.
Gap and Costco earnings are out. Courtney Reagan is doing double duty and has the numbers.
Hi there. Yeah, let's start with Gap. Shares actually surging here on this, up about 14%. So Gap earnings per share beating the street by a decent margin at 54 cents. The street was looking for 37 cents. Revenues also stronger than expected at $4.15 billion. The street was looking for $4.07 billion. Total comp sales up 3%. The street was looking for those to grow just 1%. Old Navy very strong, up 3%. Gap, the namesake brand, that was up 7%. Banana Republic comp store sales, those were up 4%. The street account actually consensus looking for that to fall about 1.5%. Gross margin pretty strong, 38.9%. Operating margin also much stronger than expected at 6.2%. The street was looking for 4.7%. When you look at the guidance, this might be looked at as a little conservative. They're looking for net sales growth between 1% and 2%. The street was looking for that more on the high end at 1.7%. And I spoke briefly with CEO Richard Dixon and CFO Katrina O'Connell. And like other retailers, the CFO O'Connell said, look, the unseasonably cold February did cause the quarter to get off to a bit of a slow start. But as weather normalized, Gap was, quote, pleased with what we've started to see in the business. And the quarter to date, all of these trends are embedded in the outlook. And Dixon said that Gap sources 10% of its product from China and less than 1% from Mexico and Canada combined. So the impact of this 20% tariff on China and 25% on Mexico and Canada is also embedded in the guidance that we just got. Now, he didn't really detail exactly if prices were going to increase as a result, but he did say, quote, our goal ultimately is to minimize the impact to the consumer, no matter what the cost inputs are across the business. So we'll hear more from them when that call starts. And then very quickly, we'll go through the Costco numbers. Those actually sort of looked like the opposite of what we saw from Gap, though shares down just about 1% here. They did miss on the top and the bottom line for the results. They came in with $4.02 for the earnings per share. The street was looking for $4.11. Revenues also lighter at $62.53. The street was looking for more than $63 billion there. The same store sales, we should though note, up 6.8%. That does include gas and foreign exchange impact. The release a little light on details, so we'll have to listen for more on that call too. Back over to you.
Mild reaction despite those misses. Courtney, thank you.
Thanks, John.
Well, coming up, more reaction to Broadcom's print and the serious pain we've seen recently in the ship chase, with that stock up almost 9%.
And later, former Fed economist Claudia Sahm on just how important tomorrow's jobs report could be after layoff announcements jumped to their highest level since 2020. Overtime. We'll be right back.